Did you know US debt is way over $38 trillion? If you're new here, me and my brother are both qualified accountants with over a decade of finance experience. And in this video, we'll be discussing 5 of the biggest red flags which could indicate that a huge market correction is on its way in 2026. Is the AI bubble about to burst? Let's start with OpenAI, which is the company that sparked the current AI boom by making generative AI mainstream. OpenAI is projecting to burn $115 billion by 2029, which is about 80 billion more than what they initially projected. Now, that's not just a small miscalculation. And to put that number into perspective, that's more than 45 times Amazon's losses before they turned profitable. And thinking about the AI industry more broadly, there's a huge amount of cash being thrown into it. And the Bain private equity firm estimates that the industry as a whole will need to generate $2 trillion in annual revenue by 2030 just to justify the massive infrastructure investments. That's more than the combined revenue of Amazon, Apple, Microsoft, Google, Meta, and Nvidia. Something else to point out is the overall concentration in AI. There's a huge amount of capital being invested in a small group of companies. And when so much performance is driven by so few stocks, it makes the entire market more fragile. Let's say growth merely slows rather than accelerates and misses investors' expectations. We could see a sharp correction as investors all try to exit the same trades. And one point that I really think is worth noting is timing. While I personally think the AI boom is real, there's still a big question around how long it's going to take before it actually pays off. Big tech is pouring tens of billions into data centers and infrastructure right now, but the revenue being generated from AI services is lagging far behind the costs. If pressure on cash flows and margins takes longer than investors expect, we could see patience wear thin very quickly. So the big question remains, are we in the calm before the storm, or are we seeing a giant bubble that's becoming too big to pop?
Warren Buffett is one of the greatest investors of all time, and has a valuation metric closely linked to his thinking, known as the Buffett indicator. This compares the value of the US stock market to the size of the US economy measured by GDP. Buffett himself once said it's the best single measure of where valuation stands at any given moment. The current ratio of 230% is roughly 77% above the historical trend line, suggesting that the stock market is currently overvalued. And why does that matter? Well, because when stock prices grow far faster than the underlying economy, it's often a sign that expectation has run ahead of reality. And that's exactly how bubbles tend to form.
Another red flag that I'm watching is the labour market, specifically the unemployment rate. Historically, unemployment tends to be lowest near the peak of an economic cycle when growth has been strong and companies have been hiring aggressively. But as economic growth starts to slow, the first thing that companies usually do isn't cut prices. It's slow hiring, then freeze hiring, and eventually begin layoffs. That's often when unemployment starts to pick up. On its own, rising unemployment doesn't cause a market crash, but it does indicate that the real economy is losing its momentum. And that can be the first domino to fall, because once unemployment rises, typically consumer spending weakens, and then that has pressures on company revenues. And then those high market valuations that we talked about earlier become much harder to justify. In the UK, the unemployment rate increased to 5%, which is the highest level in almost 5 years and slightly above market expectations. The number of unemployed individuals rose by 117,000 people from the previous quarter to almost 2 million people. And it's a similar story in the US, which has seen unemployment rate hit a 4-year high of 4.6%. So the point I'm getting at here is when unemployment starts trending higher, it's generally a sign that we're moving from a strong economy to a more fragile phase. And that's when the market starts to become more vulnerable.
Next up, let's talk about interest rates, because they behave a lot like unemployment over an economic cycle. In a strong economy, growth is solid, interest rates are low, unemployment is low, and confidence is high. As strength builds, inflation tends to increase, and central banks step in by increasing interest rates to try and cool things off, what we know as monetary policy. Interest rates usually peak late during the cycle, even when the economy still looks healthy on the surface. The problem is, higher rates don't just slow down inflation, they slow economic growth, they increase borrowing costs, and they put pressure on high leveraged parts of the market. Right now, we're in a higher for longer environment because inflation is still above the central bank targets, so rate cuts are being delayed. When you combine higher rates for longer, stretched valuation, and massive investment spending, like we're seeing in AI, that's often when bubbles start to show their cracks. And if these late cycle pressures continue to build in 2026, this isn't just a market slowdown, it's exactly how market crashes begin.
And the final red flag, which indicates we might possibly see a market crash in 2026, is debt. Debt is easy to carry when interest rates are low and growth is strong. That borrowing feels really manageable. But when rates start to rise and stay higher for longer, which is currently the environment we are in, debt becomes much more expensive to maintain. Suddenly, households, businesses, and even governments are paying significantly more just to cover their interest. And this is typically when we see defaults creeping higher. This is the US debt levels over the last 100 years. And if defaults start to rise, lenders pull back, credit tightens, and that creates a feedback loop, meaning less lending, less growth, and more stress. And that's really when the real pain can start to show up in the markets. And that, guys, is our 5 red flags that could indicate a market crash or market correction could be on its way in 2026. If you like this video, then be sure to like and subscribe. And as always, thanks for watching, and I'll see you in the next one.